Hi there, John Hardy here with the Saxo Bank FX update on this Thursday, April 14th. Question mark today is, did the yen pivot? And we had a very important final large U.S. Treasury auction this week, the 30-year coming in. And we saw a bit of a reversal in the bond market, and this saw the yen crosses bouncing as those two markets are joined at the hip. So some key supports possibly today in those yen crosses that are will have people trading off the lows on the day, and we'll look at the charts on that in a moment. First of all, today's highlights. We had yesterday actually Obama out with the budget speech. A lot of the reaction today, as I commented and as others have commented, this was no massive intelligence on my part, but it was quite clear that this was a bit of a divisive speech. Obama coming out pretty strong and trying to shore up, I think, his credibility with his traditional so-called liberal constituents. That is, we're stealing the benefits we have now from the less well-off, and we're making tax breaks for the well-off if we're going to go with the Republican plan. That's Obama's argument. The Republicans, of course, are going to refuse this logic and present their own logic, and nobody's going to present any logic that has anything to do with cutting the budget by a serious amount. So we're seeing the dollar losing ground, I think, with valid reasons, and certainly in the backdrop of this pathetic political debate in the U.S. over the budget and nobody talking anything resembling reality. So that's our perspective on that. It looks like, I think, with this kind of a speech, he's going to be willing to let it fester until 2012, hoping that he can get the popular support for a victory. Question being, of course, how does this play out as we hit that debt ceiling going into somewhere around mid-May, is what Geithner suggested, where the debt ceiling would be hit and would require U.S. lawmakers to expand it for the U.S. government operations to continue for non-essential so-called personnel. So, it's a very interesting political season remains in the U.S. and will be the case, especially after QE2 comes to an end and the economy falls apart. One imagines as well, but this debate will continue all the way through the 2012 election, not till November, and it's unbelievable how long these elections are getting in the U.S. Basically, the election season is already starting now, some 15 plus months before that. 15, but more like 18 months before the U.S. election actually takes place. Also out, we had some Euro nervousness in the European session on Finance Minister Schäuble in Germany, saying that the Greeks deal might need renegotiation. This saw a bit of panic. We did see the spreads outside of course, the Greek spreads. The Portuguese spreads went wild to the upside. And we did see a little bit of spread to Spain, and this did see the euro lower, but obviously by the end of the day, with the euro-dollar trading back towards 145 now, this has been wiped away, and it just underlines the overall weakness of the dollar here. Precious metals, very important, came raging back. This is still a currency debasement trade, and I think in many respects a flip side of the dollar. We had silver back up towards 42, gold very close to that all-time high. And some of the hiccup yesterday, apparently, I didn't put two and two together as much as some other folks out there talking about some of this being a Goldman sell recommendation on copper, and then some other comments on crude that had some profit taking in the market. And then, of course, the cynics out there, and I tend to be sympathetic with them without saying anything too direct, saying that Goldman was really looking to buy as much as it could of these things, so it put out a sell recommendation. That's certainly the cynical take on the events, but also, of course, the comeback subsequently showing that those markets are still very strong. Data-wise, in the U.S., we saw a horrible jobless claims number at 412K. This is the worst number since mid-February, looks like. A bit reluctant to read too much into this because I'm looking back at the seasonality of this time of year. I'm wondering if there's some kind of Easter effect. There are a couple of odd bumps in the charts there historically at this time of year. So let's wait for another week or two before we can draw any trend lines or draw any too many conclusions from this. From all the other surveys, it suggests that there's some momentum built up in the U.S. employment market, even though we're not super hopeful with the economy being propped up by the government. We're not super hopeful for the long term, but in the short term, I'm wondering if this is just a one-off spike in the charts. U.S. weekly confidence as well, looking pretty solid, and that gives further support to that we're not seeing a sudden new decline in overall employment situation. And this is despite the latest spike in crude oil prices, obviously, gasoline prices. The confidence, this is the Bloomberg Consumer Comfort Index, formerly the ABC, US ABC weekly number. It's risen a couple points from the week previously and has been rising quite solidly in recent weeks. Again, the US 30-year auction out, a very heavy foreign bidder interest. I think according to the chart I looked at, was the highest bidder interest on the 30-year T-bond in recent memory, so that's pretty solid. The yield, though, coming higher at the end of this auction. Of course, we had a bit of a run-up, or sort of run down in yields, and seeing some consolidation off of this. And again, that's part of the trigger for the yen and Swiss franc being sold off. Those two low yielders, particularly the yen, having a hard time finding support as long as bonds are selling off. Themes, you got to ask what can save the dollar at this point. And the question is, it's hard to tell. We certainly need to see the end of QE2. We need to see a real budget debate. We need to see a real risk sell-off to see if the market is so structurally short the dollar with basic assumptions about world risk markets, etc., that there could be simply a positioning effect there. But for now, those traditional things that have supported the dollar, as we sent out a link to the comment from Nomura's Bob Janjaway on this subject, we were also disconcerted about the dollar's inability to find support on the previous round of consolidation in risk markets. So, very big question, I think, for the entire world economy: what can save the dollar? And we need to see something that indicates that something can save it. Otherwise, we're going to have to change our outlook to something very uncomfortable, I think, if the dollar can't find support at some point soon. And that support not being found on any supreme merits from the U.S. side, but being found simply because the market's projection of what's going on in the rest of the world, or expectations, are sort of dashed by, for example, a commodity spike that finally sees tightening and economic slowdown, etc. That's getting a bit too big picture here for the moment, but obviously this is an important theme, looking at precious metals as sort of a barometer on that theme at the moment. Lack of intermarket relationships continues, whether it's interest rate spreads. I had some comments in my morning update on the Aussie, etc. Precious metals show, again, this currency debasement theme is still raging. Looking ahead, we have earnings season on right now. Google, I believe, is reporting after the close today in the U.S., and watch out for those earnings releases, as this will affect risk sentiment in the equity markets. We have Chinese data out later, retail sales, etc., for whatever they're worth, which is usually not much in terms of market movers. U.S. CPI, this is important for the Fed's, supposedly important for the Fed's understanding of inflation or feel for inflation. But again, if the Fed is going to say, and Bernanke is going to say, and he has said, we believe this is all transitory, nothing's going to happen, or this will blow over. So then you can sit there and watch it for 6 months as it spikes higher and higher without doing anything if you believe it's transitory. So the question is, does it really alter the market's view? More interesting will be the FOMC meeting on April 27th. We see if we get a few dissenters in there. I think there should be at least one, if not two, dissenters on that meeting. There's my Twitter name, @JohnJHardy. If you're interested in following me on Twitter, you can add me to your stream. Let's see, one chart I wanted to go to on Bloomberg, and now it's not popping up, but here it is. This is a chart comparing the, in white, emerging market, the MSCI Emerging Market Index. In the reddish color, it's BHP Billiton, and in the green we have the Aussie dollar. So obviously the Aussie dollar and BHP Billiton are most closely related. We have seen a sell-off, a little bit of a sell-off in risk here recently in the emerging market equities and other equity markets, and we're seeing that the Aussie didn't really pay any attention to that. You say, okay, well, it's more about the commodities metal situation for the Aussie than it is about equities and risk appetite, and that does kind of bear some weight here when we saw a bit less correlation between those two. But certainly look across these markets, look at what's correlating with what and what's diverging, because it's very important, especially I would say the BHP Billiton and Aussie. We looked back 1,000 trading days at a 0.96. That's very, very high, 0.96 correlation. The Australian dollar is definitely a commodity currency and nothing else. Charts. Eurodollar. Higher, back higher. Tested a little bit lower, that 143.75. We mentioned that as well on Twitter. Has been the weekly pivot that found support there twice. So that's a key comeback today. It means the onus is on the bears, to prove themselves. We've got this top just above 145. That's the resistance. Cable looking a bit more Morningstar-ish here, and that opens up the upside, even though interest rates don't say that it should head higher, and the UK and the US are in very similar sort of basket case circumstances. You do have the UK out with austerity, etc., trying to do something about it, whereas the US is in gaga land and not talking about reality. So one could say the background argument is there for a break higher, even if some of the fundamental supports aren't there. So interesting to see if it can break this 164 and hold it. If it does, it's a technical break and should be taken at face value, one should say. Euro sterling, the sell-off on the nervousness this morning, bouncing back up. A little bit of a trend weakener, I would say, to see a sell-off of that magnitude back below the previous high. But again, let's see what happens tomorrow and the coming days. Euro Swiss, same deal, sold off. Managed to try and make a comeback here to the 55-day moving average. And as long as bonds are selling off, if we get into another rally in yields or sell-off in bonds, you would see, one would suspect you'd see Euro Swiss back higher, testing that 200-day moving average again, as the Swiss has been tending to trade a bit like the yen in terms of inverse to what bonds are doing. Euro yen seeing the bounce, nice technical hammer there. Dollar yen bounced back to the 200-day moving average. The key support for now is a bit lower, 82.50. That's the 55-day moving average, and the Ichimoku cloud on the daily. Crude not making as quite a big comeback as we're seeing in precious metals, but certainly bears watching. Won't talk about that. Aussie or Kiwi, we sent out an idea that it's bearish below 79.45. Now that we're so close, what's the point? It did look like it was reversing this morning, but again, the dollar is having an impossible time finding any traction. So let's put that on hold for now. See what happens in the coming days. Aussie again also saw a bit of a bullish engulfing. That was confirmed a bit today after some nervousness to the downside, capped by the 105.80 area there. Dollar Canada looking more bearish after today's upside attempt higher was rejected. Look at that new 3-day high, nicely, very strongly rejected. Classic technical setup for a test possibly of the lows at wherever those are, 95, 20, 30 or so. Finally, 55-day moving average on S&P, very, very critical stuff. Was tested lower today, very strong finish. So for the short term here, looking like the bulls are carrying the day, but that's definitely a line in the sand you want to keep an eye on for sort of the broader risk picture. So with that mouthful of quick rapid fire chart analysis, that'll about do it for me today. Getting a bit frustrated with this market. It feels like we're under recognizing volatility risks, as I've been mentioning in places. Let's see what happens. I think the risks are there for something either to see a very significant adjustment lower in risk appetite, some kind of blow-ups in the current trend, or the opposite in the very short term, a melt-up. And this was a scenario I thought was kind of echoed by Bob Janjua in that link I sent out on Twitter to a zero hedge coverage of his piece from Nomura Capital. And in that scenario, we get a melt up, but then it's followed by an even more vicious sell-off on the disappointed expectations. So just feels to me like the market is kind of destabilizing here, and that the low volatility is a red herring, and we should all be very careful out there, as always. So with that, hopefully not too discomforting or uncomfortable thought, I'll leave you, and we'll be back as soon as possible with another edition of the Video FX Update. Take care out there.